Hello and welcome to traders and investors, and I'm glad to present you the daily market review prepared by analysts and experts from fx.co portal. Here we go. And we're starting with euro-dollar pair with Din Lao. Throughout Friday, the EURUSD pair continued moving sideways between the 50% corrective level at 1.1830 and the 38% level at 1889. Today, consolidation above 1889 would favor the euro and allow for some growth toward the 23% corrective level at 1.1963. Consolidation below 1830 would open the way for a decline toward the 61% Fibonacci level at 1.1769. The wave situation on the hourly chart remains simple and clear. The last completed downward wave did not break the previous low, while the last upward wave did not break the previous peak. Thus, the trend remains bullish. The bulls have paused within a broader advance that would not have been possible without Donald Trump. Trump has significantly escalated tensions globally and within the United States, and markets continue to respond by moving away from the US dollar, which is seen as carrying economic uncertainty. On the 4-hour chart, the pair rebounded from the 100% corrective level at 1.1919 based on a new Fibonacci grid and reversed in favor of the US dollar. Therefore, the decline may continue toward the 76% Fibonacci level at 1.1813. Consolidation above 1919 would increase the likelihood of continued growth toward the resistance level of 1.2040 and 2066. No emergent divergences are currently observed on any indicators. And now it's time for GBPUSD. Let's discuss it with Paulo Greco. GBPUSD remained gradually flat on Friday, February 13, despite the release of the high-impact US inflation report. The CPI slowed to 2.4% year-over-year, and a future decline toward the 2% level significantly increases the odds of a more dovish Fed stance in 2026. This week in the UK, markets will focus on unemployment data, jobless claims, wage growth, inflation, and retail sales. All of these releases are key for the Bank of England and could directly influence future monetary policy decisions. In the US, the macro calendar is relatively light, with attention mainly on Q4 GDP and durable goods orders. The US dollar has accumulated so many negative factors that the market may eventually start selling the dollar without any clear trigger. The average volatility of the GBPUSD pair of the last 5 trading days is 83 pips. For the pound-dollar pair, this value is considered as moderate. On Monday, February 16, we expect movement within the range between 1.3570 and 3736. The upper channel of the linear regression is upward, indicating a recovery in the trend. The CCI technical indicator has entered the overbought territory, warning of the beginning of a correction on January 26, which may now be completed. The GBPUSD currency pair is set to continue its 2025 upward trend, and its long-term prospects have not changed. Trump's policies will continue to put pressure on the US economy, so we do not expect the US currency to grow in 2026. Even its status as the reserve currency no longer holds significance for traders. Therefore, long positions with a target of 1.3916 and above remain relevant now for the near future. When the price is above the moving average line, it's a sign line on the graphic. When the price is below the moving average line, small short positions can be considered, with a target of 1.3550. From time to time, the American currency shows corrections, but for a trend growth, it needs global positive factors. That's all for today. See you online soon.